What are the chances that the Fed actually goes forward with the 2 more rate hikes that are being projected in the dot plot? And is there a chance that those projections are simply being put out there because the Fed was trying to send a tangible hawkish signal to prevent the market from getting carried away, which could ultimately be counterproductive to their inflation fighting initiative?
Well, I don't think it's a coordinated Fed signal because this comes from the regional Fed presidents and so on and so forth. I have to say, though, anybody you speak to at the Fed, bitterly regrets the decision to go down the route of publishing the dot plot because it gives a misleading signal a lot of the time. There's no conviction level in there. If you're sort of 50-50 about raising 2 times or 1 times and you err on one side, then the dot plot moves without actually representing how strongly you feel things should go. So, if I was running the Fed, I wouldn't be raising in July, but I've got a British accent, so I'm not allowed to run the Fed. So I think they probably will go in July. I'm not sure that it's going to be warranted, but I think they'll go there. I would be skeptical about another rate move after that because as we come through the summer, the economic data is going to be fairly convincingly pointing to ongoing disinflation. I think I'm not expecting the labor market necessarily to shift that much, but if you're getting the ongoing disinflation, you're still seeing fairly mediocre real wages in after 2 years of absolutely catastrophically bad real wages. It's not going to add up, I think, to justifying another rate hike. So 1 in July, I think, and I would be skeptical about more after that.
Paul, it's Karen jumping in. I just want to tackle the labour market angle because I caught up with one of the largest recruiters in the world yesterday, Manpower, and the CEO was telling me, look, there are just jobs that cannot be filled at this point. Employers are offering these workers more money, but they don't want to do the jobs. They want to do remote work. They want to be in offices. They don't want to be doing some of these service roles. He said, look, it's just very different this time around. I said, well, when can you see that tightness abating? I said, this year, next year? He couldn't call it. Isn't that concerning if those right up front looking at the labour market don't know when the tightness is going to end? Doesn't that make it more difficult this time around for the Fed?
Well, the thing is, we talk about a tight labour market, but then you look at the wage result, and the wage result has been terrible. In a tight labour market, your number one goal is to maintain your living standard, and no developed economy has seen workers maintain their living standards. Unemployment is low, absolutely, but real wages have been disastrous. In several countries, the worst in history. I mean, this is a very, very peculiar situation that we've got. With regards to certain areas having labour shortages, we hear a lot of complaints about this, absolutely. But then actually, when we look at it, what we're seeing is the restaurant sector, for example, is doing very well with fewer workers than it had pre-pandemic. So what's happening is business models are adapting. Automation is coming in certain areas. You scan a QR code and order yourself. You don't have serving staff coming over to take your order, this kind of thing. So we are seeing people adapt to a different labour market. And that, I think, is mitigating perhaps some of the concerns about tightness. The other important thing, the really important feature of labour markets in the last 2 years has been the churn. People jumping from company to company. And that is clearly starting to slow down. We're seeing people stay in place a bit more. That increases productivity. It lowers labor costs over time as well.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.